Good evening, everyone. Welcome to FOMC. We are going to look at what Powell is going to say today. So, nothing else than that. Just nothing much. Just just normal things. So today, we are going to be nice to each other and be nice in comments. We are also going to be looking through what is actually FOMC. What can you tell me, sir? And what I can tell you, sir, is if I just share my screen, that'll probably be the best one, actually. And then we go over there, and then we start with what is FOMC. Actually, looks like actually pretty nice overall there. Good. Let's go. What is FOMC about? It is to determine the direction of monetary policy. And then what is FOMC? It is a committee that's a bit too many but that decides monetary policy, made up of 12 members, 7 from the board of governors of the Federal Reserve System, the president of the Federal Reserve Bank of New York, and 4 out of 7 other Reserve Bank presidents. What do FOMC do? Influence the availability and the cost of money and credit to help promote national economic goals. How do changes in the federal funds rate affect the market? Short-term interest rates, forex, long-term interest rates, the amount of money and credit, and ultimately a range of economic variables, including employment, output, prices of goods, and services. What are the key indicators that Fed uses? Inflation, unemployment rate. I'm actually gonna. That's probably better. Okay, cool. GDP, housing, household spending, consumer sentiment, business sentiment, manufacturing PMI, service PMI, composite PMI, bond market, stock market, forex market, commodities market, global market, fixed investments, and other risks to economic development. How do the Fed implement the monetary policy? By lowering and rising interest, the Fed's funds rate and the bond purchase and deposits. How's the goal for Fed? But what is maybe not how? What is the goal for Fed? 2% inflation, 2.5% for GDP, and unemployment rate around, give or take, 3.5. Wait a minute. Oh, that was a fantastic introduction, right? So, today we are going to look at this brother. Isn't he looking pretty? Schnuck as always. Then we are going to have is it 50 minutes from now? Probably, no, 10 minutes, sorry. In 10 minutes, we are going to have the statement coming out. That would be the first importante informazione. And then we're going to have a press conference in 39 minutes. The next important decision to be made today is the Fed funds rate. Well, we're gonna look at a lot of other things as well. But hello, Bram. Hello, William. Hello, Preke. Hello, Kummer. Hello, Riyadh. Hello, Stara. Hello, CJ. Hello. What was it? Jus, Ash, and everybody else that I have not mentioned. I do apologize if I didn't mention your name, but there we are. Hello, Princely. Today, the market is pricing a 78% chance of a 225 to 250 basis point rate hike. No, sorry, that is going to be the end of it. That is 75 basis points or a 0.75. That is the same thing as 75 BPS, for those who can read that. Great introduction, says Ash. Very educational. Shantam says pound Swissy analysis. That is, we are going to do that later, not at this moment. We are going to prepare for this Fed meeting, and then we are going to prepare. Then we're going to read through that statement, and then we are going to do a little giveaway. I think it's going to be the last giveaway we are going to do this year. This year for some time now. This kind of like there's a couple of reasons. I'm not going to mention all of them publicly, but a word on the street might be that there isn't as much engagement around it as I would have imagined. But that is that. Euro dollar is currently on the lower side. We still have this trade plan from long time ago, and it's still working pretty snug over there. For those who are already in the sell, okay, you probably need to be at the break even. You need to expect from current price, that is 50 up at least. That is up to 118. And then you need to expect at least 50 down and anything in between. I think today is going to be $200. It will come later. It will be free for everyone, don't worry. What are the key takeaways to look at a press conference? Okay, let's go. Well, maybe I should do that, but we can go back to the slideshow over there, and we need to look at these three things in particularly. How far away are we from target? Where are we currently standing? And then we are going to look at all the other, how they're going to talk about the global market, the commodities, forex market, stock market, bond market, composites market, PMIs, business sentiment, consumer sentiment, housing spendage, and GDP, employment, and inflation. So that is going to be, now I'm not going to project what they are going to say, but let's say that they say that inflation is strong, and that they need to increase the pace of interest rates. That might look like we are going to look. Everything will be covered later on. That will probably make the dollar, probably rise. That's pretty good, right? So, what is my expectations for today? Today, my expectations are nothing else than very aggressive, hawkish Fed. We are going to see they are afraid of the too high inflation. They are going to say that the economy is strongly rising. The piece of resistance today, people, is going to be, what are they going to say about the potential recession fear? Because that's what the market is currently pricing in. And there is nothing more or worse than having a Fed that doesn't understand what is actually going on in the market at the moment. Okay, so once they put that to pretty much set in stone, or when we put that stone down, that would be that then much things will be then most things will be sorted out. So we're going to look at what they're going to say about inflation, GDP, and employment rate mostly, and then we are going to look out for what gold is currently doing. Hey, gold at the moment is in some kind of range. Nothing in particular is currently driving gold, and it is just in a range. And the same thing for euro dollar. It is currently just, dancing around, is having a pullback right now. Now, if we have a strong reaction to the upside for gold, that would likely make me buy it at some point. I just don't know when. The other thing I also need to look at is I have a sell thought process around 101.1884, or sorry, 101.88, and then we shall see if that actually comes to truth. Which pair are you guys most interested? Which dollar pair are you guys most interested to look at? That is what I want you guys to talk about right now. What is the currency pair you want me to track at the point? What asset are you currently most interested in the minutes before FOMC? So we have 63 people today. That is great. Lovely, lovely, lovely. Cash. Edward says GU. Caden says USD CAD. I've been actually looked at it for quite some time. Just going to look at that for a minute. Okay, we're still in a range. Nothing in particular there. I'll go back to Euro. That Euro, thank you. Shaw says gold. Mock says good morning. Good afternoon. I think you were been saved lately, my love. You have actually got a higher price. So, congratulations on holding on to that. Congratulations. So euro dollar. I do not know what that is, William, XBR USD, but we will look soon. So let's go to the Fed. Everyone is going to load that site in a couple of seconds. So we're just going to load that ourselves. We are going to look for something else on 15th of June here. And then I'm going to add euro dollar on the side here. And then I'm going to add this one to the other side. Okay. Let's see. Why didn't I get it? There we go. Oops. Okay, cool. That is, how many seconds is it left now? UK Brent. Oh, okay. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Let's go. Let's see what they are doing at the moment. Everyone is refreshing. Refresh. There we are. We have the current statement. We are currently seeing dollar falling at the moment. The page you're looking for has been removed. That is terrible. Come on, mate. There we go. A couple of seconds too late. I'm just going to add your dollar on the side here. Then we can load them together. Looking at euro at the moment, currently making a bit of a fuss to the upside, but still very much bearish. There's nothing to buy at this point. Gold, as you can see, is currently not doing much. Recent indicators of spending, as I mentioned before, we went to look at, and production has softened. Nonetheless, job gains have been robust in recent months, and employment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food energy prices, and broader price pressure. Nothing in particularly interesting, but they are raising the target range from 225 to 2.5. And as far as I know, that was the expected. Nothing new there. Russia war against Ukraine is causing tremendous human and economic hardship, and the war related events are creating additional upward pressure on inflation and are weighing on global economic activity. The committee is highly attentive to inflation risk. That's what they are, mostly into. So 2.5 is the current deal. They have done what they expected to do. Gold is currently rising a bit, and euro is currently rising a bit. So, for me, this is great. Great. That is an understatement, but I just want us to see, can we get some kind of pullback? I'm just going to look at also yen and pound yen as well. That is more and more into loss. Okay. So In addition to, the committee will continue reducing its holdings of treasury securities and agency debt and agency mortgage-backed security. That means that they are reducing their bonds and other assets they was buying up in COVID times, and then the committee is strongly committed to inflation of 2% objective, as always. Came as expected. Yeah. And hello, Rodriguez. In assessing the appropriate stance of monetary policy, they will continue to monitor the implications of incoming information and for the economic outlook. The committee will be prepared to adjust stance of the monetary policy as appropriate if risk is emerged that could impede that attainment of the committee's goals. Other than that, is the committee assessment will take into account a wide range of information, including reading on public health, labor market condition, inflation pressure, and inflation expectations, and financial international development. That is actually the response to a question earlier today that was done by Mr. Tom. He sent me a question there, and that is actually what they that actually describes it. So I'm just wondering, labor market conditions, and then inflation. Cool. Okay, so that was it. So far we are seeing gold going higher. I don't believe it. I'm not gonna buy it. Why do I not believe it? Because I believe this one needs to make a low before we go up again. And where do I get that from? Just my brain. Nothing else than that. Just have my brain somewhere that tells me that is going to happen anyways. Inflation remained high, and it's because of pandemic related imbalances. Higher food is what they have given as as reasoning. Do we believe that? Well, I guess we kind of have to anyways, but they have not discussed whatsoever what is what about recession, economic downturn. They have not mentioned that so far. That is actually worrisome. So we're having a pullback now on euro. We're having a pullback now on gold. Let's go back to the markets. From here, let's see. Tell me which pairs you want me to cover from now. So whatever you have posted before does not count. You have to post it again so I can see what you want me to cover in the going forward. In the meantime, bon appetit, cake. I am just going to try and see if I can make some music for you guys without blasting your ears. Is that too loud? I'm just going to see if I can talk over this music as well, where we are at the moment. But yeah. So, good. Okay. Let's go through some markets. That would be great. I'm just gonna put that one off. Good. Euro, Swissy, please. US oil, UJ, GU, GJ, Euro, Yen. All good. I don't know what the blaster is, bro. Already gave it a like, mate. Oh, what a fantastic mate you are. Thank you, mate. Euro dollar is still practically unmoved. So there is nothing to there's nothing. CJ Jack became a member. I didn't see that one, sorry, mate. But you want us to do Australian dollar, US dollar? Very much, mate. To find that, where did that happen? I can't see that on this with this one. Then oh, it just happened recently. Okay, cool. Then I'm happy. So I can't see it on my stream, mate. Do apologize for that, but nevertheless, thank you very much for 6 months in the group of e-winners, where we discuss a lot of fundamentals on every Sunday whenever I am able to. So yes, mate. So Australian dollar, US dollar. I guess you have sold it, mate, or so, to the downside, so that we can look at downside potential. That's what I guess. I read somewhere that Russia cut Europe's natural gas supply to 20%, mean most probably Europe will keep going down. That's absolutely correct. Absolutely correct. Absolutely correct. Absolutely correct. I just need to find your. There we go. And that is actually you becoming a member. There we find it correctly. So, to the downside, I want us to look at that. So, right now, we are in mostly a range. Nothing in particular great about this setup. So, right now, I just want to wait for a better setup. And other than that, it's kind of like it is important to note which kind of setup you want to see, and whatever the setup is right now, I don't like at all. So definitely need a brand new low. Hopefully FOMC can give us that us today, and then we can continue on with the move later on. Already gave it a like. That is how you should. So definitely need to break below 69.20. Jack, and sorry, need to break below to down below 69.20, and then we can look for pullbacks and look at more how things is looking like. Okay, good. But the downside definitely. The next one to be brought up to the table of which comment we should bring out is Maniac. He says GU and GJ. I can do GJ first. Sad, but true. It is going higher. It's making more losses. I want this to fall now. Other than that, nothing more than that. I would just want this to fall so I can, sell it again. So until then, I only tried once and can't really complain about that. But it is now 18 minutes until the press conference, and I want us to make a new low. Hasn't happened yet, so sorry, mate. Sorry, I can't do anything about that. The other thing is, I want us to do, yeah, I currently gonna do that one down there. Pound dollar isn't looking very frisky either. It is currently at a high and currently, not doing too great, but it is definitely something like that. That's a lot of pips down, but it definitely has to make a new low, come back again before we can sell it. So, and nothing more puts me off more than a bullish market when I'm trying to sell it. Yeah. So we say a new comment there. Simon says, has the stock market found a bottom looking at the broader picture technically? I would say no. The reason for that is pretty straightforward in my view. It's more like a range to sell again. What does that mean? That means that we do not have a higher high. That means that we do not have any particular bullish trend. That also means that, yes, this might be like an area to be buying, but it doesn't give me whatsoever anything good or great feeling of a bullish trend. Though I would love, I beg the market to go higher, I beg it to be bullish. I do not at this very given moment, or this morning, this evening, this afternoon, I don't see it as bullish because the lack of continuation higher, the lack of nice, beautiful pullbacks and continuation higher. What do you see at the moment? You see maybe a double bottom here, but then high, low. Oh, not a new high, not a lower low, higher high, maybe a higher low. But I will be the fool, but I will not be the first one to buy it. So I am definitely wanting to buy this very eagerly. I'm like, can I buy it now? Can I buy it now? Can I buy it now? But I've learned I will just burn myself. So I feel the GJ struggle, say Ryan Atkinson, closed a losing trade because I didn't want to keep it running during FOMC. That is okay. That is okay. That is your choice. Can't make you do anything I don't want to do, but you do you. True GJ sadness, really, yesterday break even. It hurts. Okay, that is definitely something that does hurt me as well. But yeah, just going to hide you. Thank you very much. That would be great. The next thing we then need to discuss is, does Nasdaq have any better opportunities? Yeah. It's kind of like a crying baby. And when you're a new parent, you don't really know what to do. It's kind of like not giving it to you. The reason why I'm not currently buy is the lack of continuation higher. If this was doing that, I would be on it, baby. I would be on it, baby. But honestly, I don't want to lose money more than I already have. So let me keep those together. Eurodollar at the moment is currently moving absolutely nowhere. So, sorry if you were hoping for a spectacular higher high, but no, thank you. It hasn't happened yet, and I really look forward to it. But it is thus it is. Sorry, people. I just need to give myself another break. I just need some drinking. Okay, thank you, please. Doesn't want to do it now, eh? Okay. Just be stubborn, eh? Dollar goes higher, Kasasa. Dollar goes higher. Who was it? Shuran comes in with a congratulations for seeing that all the way through to India. But yeah, I am sick. I have been in bed all day. And I am probably going to take a break for 2 or 3 days now because I am exhausting myself. I don't want to. Well, people, I'm not going to cry, but I am definitely not well. I do apologize. I'm not going to complain. I'm just saying I'm not well. I have high fever. I'm currently. I have like a blanket here. I have wool underneath. I have just so I don't freeze because that would make me more sick. And then tomorrow I will probably not be streaming either way. But I do apologize. I don't want to be. I don't want to. I don't want to point it out. I don't want to be. I don't want to be negative, but yeah. Harold told me to go to bed. Um, I didn't listen to him, so he's probably going to yell at me. But yeah, I do apologize if this is a bad stream. This is a bad stream, but I tried. I definitely 100% tried to be with you guys. Definitely want to be with you guys. By the way, I have another couple of other things I want to mention to you guys. I'm not going to sell, I'm just going to mention it to you. There is one guy who gave me a testimonial today. He said, if you're serious about learning how to trade, like most things in life, you will do with a mentor. I would recommend IvanFX. Doing a wonderful job presenting complex information and easy to understand in a logical format. He is patient. He has a genuine desire to see you succeed as a trader. The knowledge that I've gained from him and e-winners community, my private group, put me ahead light years compared to where I would have been if I was chosen to walk this road alone. I highly recommend. That guy is called Michael. I think I'm allowed to say that, but yeah, he is one of my mentees. Just if you were wondering if the mentorship is working. Okay? I have plenty more to come. Do not worry. I'm not here to sell. I'm just here to tell the good story, and then it's totally up to you. If you want to, also want to mention to you that it's going to end. New submission of new people is going to end in a couple of 4 days. Sorry, is it 4 days now? 31st. So that day there, that Sunday. On Monday, you can't join the mentorship for until further notice. I don't know when that is, but that is until. I do not know. I have missed meetings today. I do not know, but I'm trying. So yeah. What else are we gonna do? Well, if I lose my trail, just help me out. You know, don't be a don't don't tell me what to do. Tell me what to do today. If I pressed something, done something wrong, sorry. If I said too much, I'm sorry. Okay, I'm sorry. I'm just sorry. Cool. Ash is 100% agreeing with Michael. Okay. New Zealand yen, I did not make money on it. I have seen that, James. I wanted to respond to you. I do apologize for that. It is what it is, I guess. I don't know what happened to your trade in New Zealand yen, but mine is still alive and kicking. So I don't know what. Maybe you put it to break even or so, but that trade is still alive and kicking for me. So that is a trade that I took a couple of days ago. I just want to point that out. Where is it? It is New Zealand yen. New Zealand yen. It is here. I sold New Zealand yen at around 85 and a half. Stop loss at 86.20. I sold 85 and a half. That would probably be around, is it here, give or take? Somewhere around there. And stop loss around 86.20. That would be up there. So that is how my current sell. Oops, that's how my current sell looks like. With a target of weekly, bearish, weekly, all the way down to here. So I'm still alive, still kicking. Kirkland says euro dollar, and James says New Zealand euro New Zealand. I don't have any buys on euro New Zealand, James. I wanted to buy it. Nick sold it, and Trader Nick, if you wondered, and it is what it is. I can't really. I have nothing to complain about. I'm just waiting for it to go higher more than anything else, and yeah, hope that is hope it's worth it as long as it is there. So yeah. Is Nick already done streaming? Ask Quake. Okay. Wow. Fair enough. I sold 85.64. 85.64. And that is New Zealand yen, I think you're talking about. You sold 85. 85.64. So you got a better entry than me, mate. So okay. I never put mine to break even though. So yeah. Don't be fooled. Dollar will strengthen. Yeah, it will. I'm not saying it's gonna fall. So yeah, just waiting for it. But go back to euro dollar. Okay, still somewhere in the middle. Can't complain. New Zealand dollar, still falling a bit. So that was actually a good. That was a good trade. Okay, can't complain. Pound dollar, waiting for it to go lower. It's not currently going lower, and dollar's currently, having a bit of a pullback before it eventually will go higher. The question is, why is it falling? Well, it's already in price in whatever has been mentioned today, and we need to be able to differentiate different things. So, or in terms of what is new news, what is bad, what is old news, what is not news. And so far, nothing new has happened. It's just somewhere in between there. And then, yeah. So I'm just going to add this one maybe. I don't know if that works even, but yeah, okay, cool. That one. Had to hit this guy and add myself in the corner, I guess, maybe. Can we do that, maybe? And then can we make him like a bit less transparent? Probably we can. Okay, cool. Cool. Just gonna make a new thumbnail here, people. Just trying to make a new thumbnail. And it ain't easy. Okay, cool. I'm just gonna download that and then add that to whatever we're doing, whatever we are at the moment. There we are. Good. Okay, cool. Good. What is important for today, people, is to hear what is he saying, what is he doing, and for the love of God and all those things, is hopefully mentions something about recession fears. Okay, let's hope he does. Okay. What version of Season X do you start with? Is like okay. Philios trade. That thing is about to expire. Actually, that 20% off. So that is a good question. Actually, what is the best thing? It's totally up to you, bro. What I would say, at least start with the 3-day free trial, for the love of God. Next one is light. I would personally say that at least full is a place to start. And I know it's a lot of money, but you need to have access to some of this seasonality screener, at least. So this is just having access to all instruments in terms of historical data, but the seasonality screener is the kicker there. So start a free trial, get to know what it is about light. Do you like it or not? And then if that's what you can afford, cool, good. But I'm currently myself on business. Because that's what I mean, and most people should be able to do anyways. Sorry, you should have. That is my personal opinion. Are we able to? Totally different question. Papa Powell is pumping dollar bags. Let's see if we can find him on the internet. Let's go see if we can find him. FOMC. Let's see. There they are. And there they are. Cool. Just going to hear. Starting the music there. Unmute site. Cool. Just going to hear. Okay. Music there. Oops. Unmute site. Cool. That wasn't my point. But yeah, cool. Start out with light. Start out with what you want. But if you're able to pay for higher, that would be the better. How long do you hold the trades? I can hold until December. So 3 or 4 months. I can hold one losing trade for 1 day, maximally, until I don't want to lose much. So give or take 1 day. Losses, winners are pretty big.
My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. This process is likely to involve a period of below trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with...
Hold on. Recession. What about recession? Do you think we're in recession? And do you think that we are about to go into recession? Okay, are we going into? What do you think about it? What are we going to do? Okay, cool. Tell me.
The Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look for because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times. In normal times, what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina.
That statement down there is making the market move.
Hi, Jerome. Thanks for taking our question. Gina Smilek, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect that And we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on the path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down. And we, as I've said on other occasions, price stability is really the bedrock of the economy. And nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do. And we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I mean, I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared. And the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will, support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates? And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. we were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to, 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we some 20 plus years ago moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine. And it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand.
Thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation, still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say you and also anecdotally, you hear much the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
Before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how to forecast the possible recessions from banks and economists? How does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts. How do bank forecasts the possible recessions, economists? Does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was was getting, the process of getting back down to the new equilibrium will take a while. And that time, it's hard to be precise, but, the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was. But we looked at this carefully and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place, got forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation, but I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly, different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month. And, we kind of thought we had the story, probably had the story right. But then I think in October, you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the US in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests.
All right, people. Your time has come. I'm about to fall off this chair. I'm sorry. I'm not well. I'm getting worse every second here. What are we gonna do now is I haven't made up my mind of how much, when, and whenever, but I think I will just do it, and then we'll just deal with the repercussions later on, I guess. What was the amount I mentioned earlier today? What was the amount I mentioned earlier today in this stream? Ska vi se. Okay. I think I'm just going to do that actually. Okay, save. Because I can't remember how much it was supposed to be. I don't want to disappoint anyone, so since I said something, we'll just do it. How much should it be? Well, how much should it be? Give it 100, and then I honestly cannot remember. If you go back in the stream, I'm sorry if I said another number than 100, but I will just say 100 now, and then you guys can slap me both ways. I said 200. Okay. So 200 is to whoever. The question in mind today is going to be, ska vi se, this word here. This one. if you type that hashtag, it has to be hashtag like that, and then you do you, and then we will catch someone in a couple of minutes while we're waiting for Powell to still talk.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession or we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now. And I've explained why that is the case. It's because you do see a very strong labor market. And I think the public will see that as well. You know, going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant increase in unemployment. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For a financial stability perspective, you know, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets. And so you have a pretty, from a financial stability standpoint, you have a pretty decent picture. Now, the macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, you know, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that you know, in many cases their paycheck, it doesn't cover the food they're accustomed to buying. We're seeing actual, you know, real declines in food consumption. And
so the big takeaway today is that they might not raise as much as the market has priced in. That's why dollar is falling. And in the other market, the S&P is going higher, gold is going higher. Fair enough. That's the most important thing today. Type hashtag ball strategy to give away $200 if you want, as everyone else does. I am going to give you one more minute. We're going to take that in 50 seconds, and then we will take it.
It's very concerning. It's
to translate what Fed policy means to them in this complicated economic landscape.
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job. It is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people. And we're going to use our tools to do that. As I mentioned,
that was his last word. Who is it going to be? We have now 31 entries. That's pretty low, depending. That is, we're actually 67 people right now viewing. Fair enough. Who is it going to be? You have to contact me at forex@beetle.no. Forex@beetle.no if you want that one. It is Ahmad Z. Contact me on Forex or on Discord within 24 hours. If not, you will lose it. So have a good day, people. I'll see you soon. I don't know where, but we will see each other at some point. Adios. Adios. Boom.